Okay, folks, I just thought I would jump on here and have a little word about what's kind of going on in the markets. Um, and what we haven't seen this year, even though we've seen a lot, if not everything, um, what we haven't seen this year is a government shutdown, a prolonged government shutdown. And the tail effects of this are actually starting to come really to the fore. And as we can see, they're starting to read across into these markets. So, what are some of those tail effects? Well, we've seen the SNAP program, which provides food for about 46 million Americans. And that is now being paused. And so, therefore, there is a huge amount of food aid that is not being delivered to millions and tens of millions of American families. What also is not happening is that a lot of the liquidity that the government provides into the general system via uh, loan support programs, military spending, military finance assistance programs, all this sort of stuff like the Navy Bank, all these sorts of things are halted. Therefore, there is a huge stop on liquidity coming into the system. But have no fear, as of last Friday, the finance houses, the banks, and so on and so forth have hit up the repo facility, which is essentially a facility where the Fed can loan money out to the financial institutions in exchange for those financial institutions putting sort of on pawn, if you like, mortgage-backed securities, and their treasuries that they're holding. Now, I'm not sure if the loan that they get is the mark-to-market value or the face value paid for those treasuries and MBS. I wouldn't say it's mark-to-market, but it doesn't really matter. Net net, what's happened last Friday is a lot of the banking institutions in America have gone to the Fed and they Friday. Sorry, the squawk just coming in here in the back. So Besant is talking at the moment on CNBC, but I want to finish this. That $50 billion worth of uh, of of repo facility has been given out as of Friday. As of yesterday, there was another $20 billion taken out of the repo facility by these financial institutions. Why is that? Because this government flow of cash is stopped. And we're not going to get into the reasons why they can't break the impasse of the government shutdown at the moment. That's a totally different situation, but it's to do with healthcare insurance plans. But um, the thing that we need to be concerned about as traders and market participants is this liquidity sort of crunch and then the relief that should trickle down now from the money that they've loaned on Friday and yesterday. But um, it's just kind of serving to highlight and underpin a quite a large amount of softness that's come in yesterday. And yesterday, data wise, we did actually get some data out of the markets. That was ISM manufacturing. The PMIs came out for at 48.7, below expected 49.4, prior 49.1. So that's below the prior 49.1, coming out 48.7. That's for ISM manufacturing PMIs. Um, and also the manufacturing prices um, came out pretty weak there, 58 even miss on prior 61.9, expected 62.4. All right. Now, here's what's different that I don't think we've seen this all year. We get bad data, the market all this year, brief little pullback, and then rally, rally, rally into the highs. Your all-time highs, whatever, just rally into the highs on the session. You get bad data. The worse the data, the stronger the bid to the highs. Okay, so what's happened yesterday? Bad data, market prints down, closed on the lows. Okay, so well, actually, it closed mid. We wouldn't say it closed on the lows, but reopened and we're down pre-market 1% here on SPOOs. We'll go through a couple of these other markets. So, what that's quite interesting. So, there's two things here that have not happened previously this year is